Welcome back to the Options Blueprint podcast. I'm your host, Professor Options, and I'm thrilled to have you join us for our second episode, where we'll dive deeper into the fascinating world of options trading.
Hi everyone, I'm Sarah, a student of the professor, and I'm excited to be back for another episode. Last time we covered the basics of options, and today I have so many questions about put selling strategies.
That's right, Sarah. In our first episode, we covered the fundamentals of options contracts. Today, we're focusing specifically on selling puts, a powerful strategy that can generate consistent income and potentially acquire stocks at discounted prices.
I've been doing some reading since our last episode, Professor. From what I understand, when we sell a put option, we're essentially getting paid to promise to buy a stock at a certain price. Is that correct?
Excellent summary, Sarah. When you sell a put option, you're taking on the obligation to buy shares of the underlying stock at the strike price if the option is exercised. In return for this obligation, you receive a premium upfront from the buyer of the put option.
So the premium is basically our payment for taking on this risk, right? That's what makes this a potential income strategy.
Exactly. That premium is yours to keep regardless of what happens next. Think of it as compensation for your willingness to buy the stock at the agreed-upon price. Many traders use this strategy specifically for the income potential from collecting these premiums.
Could you walk us through the basic mechanics of selling a put, maybe with a real-world example?
Absolutely. Let's use a popular stock like Apple as our example. Let's say Apple is currently trading at $200 per share, and you wouldn't mind owning Apple at $190 per share.
That sounds reasonable. Buying Apple at a $10 discount would be nice.
Right. So you might sell a put option with a $190 strike price that expires in 30 days. For taking on the obligation to buy 100 shares of Apple at $190 per share, or $19,000 total, you might receive a premium of, let's say, $3 per share.
And since each option contract represents 100 shares, that would mean I'd collect $300 up front for this one contract, correct?
Spot on. You'd receive that $300 premium immediately in your account. Now, one of two things can happen by expiration. Either Apple stays above $190 by expiration, or it drops below $190.
What happens in each scenario?
If Apple stays above $190 by expiration, the put option expires worthless. The buyer won't exercise their right to sell you shares at $190 when they can sell them for more on the open market. You keep the entire $300 premium. That's 100% profit on the option.
And if Apple drops below $190?
Then the option will likely be exercised and you'll be obligated to buy 100 shares of Apple at $190 per share, or $19,000 total. But remember, you've already received $300 in premium, so your effective cost basis is actually $187 per share.
That's still below the original $200 market price when we started, so it's like buying at a discount.
Exactly. And that highlights one of the key benefits of selling puts. You either generate income when the option expires worthless, or you buy a stock you were willing to own anyway, but at a lower effective price than when you initiated the strategy.
How do we choose the right strike price when selling puts?
That's a great question. The strike price selection depends on your outlook for the stock and your risk tolerance. Higher strike prices, closer to or above the current stock price, offer larger premiums but have a greater likelihood of being assigned. Lower strike prices offer smaller premiums but have a lower probability of assignment.
So if I'm very bullish on a stock, I might sell puts with strikes closer to the current price for higher premiums.
Yes. And if you're more cautious, you might sell puts further below the current price for smaller premiums, but with less risk of being assigned shares.
What about expiration dates? How do we choose those?
Expiration selection involves balancing time decay and duration of risk exposure. Options lose value over time due to what we call theta decay, or time decay, which accelerates as expiration approaches.
So shorter-term options decay faster.
Precisely. Shorter expirations, like 30 to 45 days out, benefit from accelerated time decay, allowing you to collect premium more quickly. Longer expirations offer larger total premiums, but tie up your capital for a longer period and expose you to more market uncertainty.
I've heard terms like cash-secured puts and naked puts. What's the difference between these approaches?
An excellent question that brings us to risk management. A cash-secured put is when you set aside the full amount of cash needed to purchase the shares if the option is assigned. In our Apple example, you'd need to have $19,000 in cash available.
So with cash-secured puts, I'm fully prepared to fulfill my obligation if I get assigned the shares?
Exactly. It's the more conservative approach. You know exactly what your maximum risk is, buying the shares at the strike price. A naked put, on the other hand, is when you sell puts without setting aside the full amount of cash needed for potential assignment.
That sounds riskier. How does that work?
With naked puts, you're using margin from your broker instead of cash. Your broker will require a margin deposit, typically 20 to 50% of the assignment value, depending on the stock and your brokerage's rules.
So instead of setting aside the full $19,000 for our Apple example, I might only need to set aside, say, $5,000?
That's the general idea, though specific margin requirements vary by broker and the particular stock. This approach allows you to generate a much higher return on capital, but it comes with significantly higher risk.
So what happens if the stock drops dramatically and I don't have enough cash to buy the shares?
That's the danger with naked puts. If the stock drops substantially below your strike price, you could face a margin call requiring you to deposit additional funds. In extreme cases, your broker might close your position at a significant loss to protect themselves.
That sounds quite dangerous for beginners.
It certainly can be. That's why I generally recommend that new options traders stick with cash-secured puts until they thoroughly understand the risks involved. Naked puts are more appropriate for experienced traders with larger accounts and higher risk tolerance.
Are there specific market conditions where selling puts works better?
Great question. Put selling generally works best in sideways or gradually rising markets. During sharp downturns, put sellers may face losses or unwanted assignments. In extremely bullish markets, you might miss out on some upside by having your cash set aside for put obligations.
How about choosing which stocks to sell puts on?
I recommend selling puts on stocks that you've thoroughly researched and would genuinely want to own at the strike price. Quality companies that you believe have long-term value make the best candidates. Avoid selling puts just because the premium looks attractive.
That makes sense. You're essentially saying don't sell puts on stocks you wouldn't want to buy.
Exactly. Many successful investors use put selling as a way to potentially acquire shares at a discount. Warren Buffett has famously used this strategy on occasion.
What about position sizing? How many put contracts should someone sell?
Position sizing is crucial for risk management. A common guideline is to ensure that if all your puts were assigned, you wouldn't have more than 3 to 5% of your portfolio in any single stock. So if your portfolio is $100,000, you might limit yourself to put obligations that could result in a $3,000 to $5,000 investment in any one company.
And I imagine diversification matters too, not selling puts on too many similar companies.
Absolutely. Diversification across different sectors and industries helps reduce the risk that a single event could trigger multiple put assignments simultaneously.
Are there any tax considerations we should be aware of with put selling strategies?
Indeed, there are. When you sell puts, the premium you receive is not taxed immediately. If the puts expire worthless, the premium is typically considered short-term capital gain. If you're assigned shares, the premium actually reduces your cost basis on the shares.
So in our Apple example, if I get assigned, my tax cost basis would be $187 per share, not $190.
That's right. And that will impact your eventual capital gains or losses when you sell the shares. I always recommend consulting with a tax professional about your specific situation, as tax laws can change and individual circumstances vary.
This has been so informative. Let me see if I can summarize. Selling puts can generate income through premiums. We can use cash secured puts as a conservative approach, or naked puts for higher returns but with higher risk. The keys are selecting appropriate strike prices and expirations, and only selling puts on stocks we'd want to own.
Excellent summary, Sarah. And remember, consistent success with put selling comes from developing a systematic approach rather than making random trades. Start small, be consistent with your strategy, and always know your risk tolerance.
That sounds like solid advice. I think I'll start paper trading some put strategies this week.
Wonderful. And remember, everyone's journey with options is unique. Take your time to learn, stay disciplined with your risk management, and don't hesitate to adjust your approach as you gain experience.
Thanks so much, Professor. I feel much more confident about put selling strategies now.
It's been my pleasure, Sarah. And to all our listeners, thank you for joining us for this episode of the Options Blueprint podcast. If you enjoyed today's discussion about selling puts, please subscribe to the podcast, leave us a review, and share with friends who might be interested in options trading.
And don't forget to join us for our next episode, where we'll explore credit spreads, another fantastic option strategy for income generation.
Professor Options is here.
And Sarah.
And until then, we're wishing you successful trades and continued learning on your options journey.